Business development companies, or BDCs, play a unique role in the financial ecosystem. These entities provide capital to small and medium-sized enterprises that might not otherwise have access to funding. Now, an important factor that influences BDC operations is interest rates. So what impact do rising or falling interest rates have on BDCs? Firstly, let's consider increasing interest rates. When rates rise, the cost of borrowing climbs higher. For BDCs, whose primary function is to lend money, this can mean higher interest income if their loans are often at variable rates. Essentially, they can charge more for their loans, leading to higher revenues. This is advantageous as long as the borrowing businesses can handle the increased debt payments. However, if rates get too high, it may lead to higher default rates, posing a risk to BDC portfolios. On the other hand, higher interest rates might also impact the value of BDCs' equity-like investments. As borrowing costs rise, the businesses these BDCs support might struggle with growth, possibly affecting valuations and thus the return on equity investments. Now let's talk about decreasing interest rates. When rates drop, borrowing becomes cheaper, stimulating business activity. For BDCs, this can lead to more businesses wanting financing for growth, leading to increased lending opportunities. Lower interest rates generally translate to lower borrowing costs for businesses, reducing the chance of default and enhancing the overall quality of the BDC's loan portfolio. However, there's a downside. Lower interest rates might compress the margins BDCs earn on their loans. Fixed-rate lending programs could also be less profitable, impacting their revenue stream negatively. In the end, neither increasing nor decreasing interest rates are universally better for BDCs. The optimal scenario may involve moderate interest rates to balance revenue from interest income against the risk of loan defaults. For investors in BDCs, staying informed about rate trends and their potential implications on portfolio companies can provide strategic advantages in maximizing returns.